This is certainly the most important non-farm payrolls report we've seen. We're used to having these very important CPI reports that everybody's hinging on, but now that growth, not inflation, is the focus, this is one of the most important reports we're going to see. And I think anything below about 125,000 on payrolls or a rise in the unemployment rate to 4.2 or 4.3% would exacerbate a lot of the concerns that we saw in yesterday's market, where bonds were rallying, not just on hopes for rate cuts, but on genuinely negative growth revisions, and stocks were falling in sympathy with that. So if we come into consensus, that'll be fine, and the Fed will be okay to hold and to continue to project confidence about cutting rates in September by 25 basis points. If we get a negative reading today, those calls and those clamors for 50 basis points at the September meeting are going to get a lot louder.
I would like to understand in which camp you are, because I've seen a couple of comments of investors looking at the latest manufacturing data and actually saying that the Fed should have cut this week. Do you agree with that opinion?
Yes, the Fed could have cut this week, and probably in retrospect should have cut this week, just based on a lot of data we saw yesterday. There's not much in the inflation data that we're seeing or leading indicators for inflation. Employment cost index, the productivity numbers were very good, so they shouldn't be as concerned about inflation. They should be more worried about growth. I think specifically the reason to be worried about this month's payroll report, the one we're getting this morning, is that we've seen initial jobless claims and continuing jobless claims climbing. And that's also come at the same time as we've seen the JOLTS hiring rate fall. So it's not necessarily that a lot of people are losing their jobs, but we are seeing more people file for unemployment insurance and stay on unemployment because it's getting harder to find a job. And if hirings are getting weaker, we're expecting payrolls to move down too. That said, we're not expecting a disaster in this morning's report. We haven't seen enough other data to tell us that things are really coming apart at the seams in the US labor market, just that we're seeing incremental slowing. So if we're seeing the 6-month or the 3-month moving average in payrolls slowing gradually, that's not going to ring as many alarm bells. If we see a huge negative surprise today, that's going to I think, validate a lot of the concerns that people have about the Fed being behind the curve.
Right, let's talk portfolio then, because I did see your comments suggesting that the recent rotation into cyclicals and small cap is likely to continue, but you think the window is narrowing. Talk us through the timeline that you see here, and ultimately why. Why is this likely to end in the near future?
So we always thought the upgrade that we made to small cap stocks would be short-lived. We upgraded from negative to neutral weight in our portfolios. And that's because we looked a little bit at history. 1995, really the last time you can find that there was a soft landing. We still think that's a reasonably likely case in this outlook that we have here. That small caps rallied after the Fed started cutting rates, but not for very long. They gave back a lot of those gains when it became clear the Fed wasn't going to cut rates that many times because the economy wasn't that weak. So you can get these really powerful short pockets of cyclical value, small cap outperformance, but it doesn't mean it's going to last a long time. And certainly if rates are falling because the growth outlook is getting worse, that's not a good environment for cyclicals and small caps. So there's always that risk too. That's really what we saw manifest yesterday. So we're keeping an eye. We're neutral on small caps, so we're not in a position where we're overweight and we have to think about downgrading them. That said, we are also underweight things like high yield bonds, which are very correlated to small cap, because we don't want to add too much risk to portfolios at this stage when we just don't know what the growth outlook is going to be for the second half of this year, certainly going into next year.